Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report, and we're of course going to talk about the effect on risk assets like Bitcoin and the stock market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Obviously, risk assets recently have been stuck in traffic on Struggle Street. We've talked a lot about a weakness between February Opex and March Opex. So my base case right now, despite whatever data is coming in with regards to the labor market and with regards to inflation, is that there likely will not be any type of durable bounce by risk assets until at least March Opex, which is a little over a week away. It could take as long as early to mid-April if the markets are going to simply wait for more macro data to come in, meaning labor market data and inflation data. There's precedent for both of those outcomes. If this cycle plays out like most cycles for Bitcoin, then it would start to show a little bit of strength as we get further out into the second quarter, especially early on in the second quarter. And mostly if you look at 2017. 2021 was obviously a little bit different, but in 2017 there was a fairly weak Q1 and then a fairly strong Q2. But there's also other ideas that I want to present to you as well, in which case it could take a little bit longer than March OPEX, potentially going into early to mid-April. So I would say March OPEX at the earliest. Could take a little bit longer if these macro data points are going to be needed to provide some justification to the market. If you look at inflation, it dropped right to 2.81%, which is a good thing. I mean, it's some people are asking, well, like if inflation came in lower, why is the market going down? Well, look, as I've said, between February OPEX and March OPEX, it was likely going to be a risk-off time. In fact, the entire pandemic crash occurred between February OPEX and March OPEX. But the thing right now that I think markets are sort of grappling with is, ever since the Fed started to cut rates in September, inflation had been trending higher, thus making the comparisons to the 1970s somewhat relevant, right? And we saw inflation bottom out in the summer of 72, and then it slowly went up until 73, where it exploded higher. And same thing happened the cycle after that, right? Inflation bottomed out, and then it slowly went up. And then both times we ended up getting an earlier peak than we wanted. And so, of course, the markets are a little bit concerned about inflation, especially considering that the Fed had started to cut rates. Now, there's been a lot of uncertainty introduced into the market recently due to all the tariffs and whatnot. Now, there's two ways to think about tariffs, and I don't think that either view is necessarily wrong. Let me explain what I mean. One view that people say is that tariffs are inflationary. Other people say that tariffs are deflationary. I say both could be correct depending on where we are in the cycle. What I mean by that, if the consumer is not tapped out, meaning there's still strength by the consumer, then tariffs are inflationary. Because what it's going to do, businesses are going to raise prices, therefore their bottom line should continue to do well as long as the consumer is not tapped out and willing to pay higher prices. If the consumer is tapped out, then businesses raising prices to pass the tariff cost off to the consumer is not going to work well. The consumer will revolt against higher prices, and then the earnings of those companies will drop a lot, leading to a massive devaluation in the stock market and ultimately layoffs. So, tariffs can be inflationary, they can be deflationary. It depends on where in the cycle we are, right? That's ultimately what I think. And so, regardless of the ultimate outcome of that, a lot of this uncertainty recently is shaking things up in the market. A lot of headlines that you see in the morning are completely out of touch with the reality by the afternoon. They're completely void, and no one cares about them anymore because of how much policy changed over the course of the next few hours of the day. the uncertainty associated with that is difficult for business owners. I've talked to a few business owners, and they've essentially said it'd be better just to know what the tariff is. That way, they can adjust for it. But it's the changing of it and the constant not knowing what the ultimate tariff is going to be. That's what's making things difficult, and that's allowing the markets to ultimately sell off. Now, I think Trump wants the markets to sell off in the short term because he's a real estate guy, and he knows that in order to get real estate back to what it used to be, you need low rates. And I think he'd rather get this uncertain phase over with now and front load a lot of these changes in policy than to drag it out over multiple years. So by front loading it, it leads to a pretty big deleveraging in the markets. And then I'm guessing sometime later on this spring, that rhetoric will start to die down. But in the short term, inflation did drop a little bit, which is good news. It's good news. And ultimately, there's a lot of the comparisons made to the 70s. And I've kind of been on the fence about the whole 70s thing. I feel like I've sort of leaned more towards it's not the 70s than it is. One of the reasons for that is because in the 1970s, when we got a second wave of inflation, it was after the unemployment rate had been going up for a while, right? And if you want to take a look, right, don't just trust what I'm saying, let's go verify it. If you overlay the unemployment rate onto this chart, and then you also overlay the inflation rate, one of the things you'll notice here is that in the 1970s, let me switch this over to a monthly time frame because we don't really need weekly on this data. But yeah, if you look at the 1970s, what you'll notice essentially is that in the 1970s, when you had these recessions right here, and you had, say, sort of like a second wave of inflation, that wave of inflation occurred, right? So the inflation rate is the purple line. This second wave of inflation, this wave of inflation right here occurred as the unemployment rate was going down, right? And then the next wave of inflation occurred while the unemployment rate had been trending down for a while. Whereas this cycle, we're seeing the opposite, right? And we're seeing inflation trend down, and the unemployment rate, if anything, has been trending up, not down. So I don't really think it's the exact same thing as the 1970s because wage inflation should not be as prevalent today. Now, one way that it could turn into that is if the powers that be are not willing to tolerate as much pain as they should. For instance, if you look at the S&P divided by M2 in 1998, it also corresponded with the Fed reducing rates by about 5.5% to about 4.75%. So 75 basis points of rate cuts. This time it was 100. But ultimately, the market back then got a big drop, about a 20% drop, and then went into a larger distribution phase. You see that larger distribution phase? So if the markets drop like this, if the S&P ends up dropping 20% from the local high and we get sort of a brief recession, obviously the Atlanta Fed's already calling for negative GDP in Q1, and then there's a lot of money printing and central banks everywhere start to ease a lot, and if it leads into another distribution phase way up there, then yeah, it's possible that you could get another wave of inflation. It all really depends on if the Fed's willing to stay the course long enough and also what happens at the fiscal level as well. But right now, with inflation, it's a good thing that it's coming down, right? It's not a bad thing. It's a good thing. Markets might also be a little concerned because if businesses are not able to pass on rising costs to the consumer like they once were, then that could put a headwind on earnings for those companies. So I would argue inflation dropping for 1 month is great. There are times, though, where it did drop for like 1 month back over here, and then it just went up a lot the following month. So I don't really think we should put a ton of weight into it yet. And that's one of the reasons why it might take into April for the markets to see another inflation print to get more confident that inflation is actually coming down, and this isn't just a single data point. Obviously, with the stock market dropping, that should help things with inflation. We're already seeing, the price of eggs is essentially collapsing right now, which is a good thing. But I think that is the thing to consider. And by the way, if you look at the S&P divided by M2, this drop over here basically lasted for a couple of months. Okay, so if it just goes through March Opex, that's only 1 month. If it goes into April and well into April, and that's getting you closer to that 2 month time frame, that 2 month time frame, which is exactly what that drop ended up being. Now, if we were to look closer at inflation, it will kind of explain why I'm not at this point seeing a second wave. And I want to be clear, like, it doesn't mean that a second wave won't occur, but I just think that right now, given the data that we have, given where things have been trending, I would lean more towards not a secondary wave. That doesn't mean you can't have higher inflation that's a lower high, but I don't really think we're going to have like a massive secondary wave of inflation where inflation goes beyond 10% anytime soon. And I could be wrong. If we get a big jump in inflation in the coming months, then I might change my mind. But right now, it's not my base case. If anything, I'm more concerned about the labor market than inflation, right? I'm more concerned about the unemployment rate going up as the next couple years go by rather than inflation. I think that might be the bigger issue that this cycle will have to contend with. If you break inflation down by category, let's take a look. This is headline. Look at food and beverage. It has been going up a little bit, but it's not that much, right? On monthly change, relatively low. Food and beverage inflation is right around 2.5%. That's not that concerning to me. That's basically where they want it to be. Housing inflation continues to drop. Now, remember, housing inflation is one of the biggest component. It is the biggest component of inflation. And I don't really think that housing inflation is going to continue. I don't think it's going to start going up anytime soon. And because I think that housing inflation will continue to fall, I think that's going to be a headwind for inflation going higher, thereby making it where it's more likely to continue to see lower headline inflation. But again, housing inflation continues to drop. It was actually steady the last couple of months, but overall, the trend has generally been down, right? If you look at a monthly change, it has been down. I guess the downward motion has been getting less negative. If you take, if you look at the derivative, but it has at least been down. If we look at apparel inflation, 0.5%, nothing really to worry about there. Transportation, 1.58%, nothing really to worry about there. Medical care, around 3%. We kind of would like to see that a little bit lower. I know a lot of people don't necessarily believe that medical care inflation was medical care was deflationary back in 2023. It doesn't really feel like that, but that is a little too high, I think. I think we'd like to see it closer to that 2% level or negative, if we're being honest. Recreation has been going back up some from a low of 0.7%. Now it's back up to almost 1.8%. So worthwhile to keep an eye on that. Education and communication has been continuing to drop 0.334. And then other goods and services. This is one I got really optimistic. I was really encouraged by last month because it dropped from 3.26% down to 2.38. I really liked that drop. Now it's back up to 3.27, right? It's back up to higher than where it was 2 months ago. That's not what I want to see. I really would like to see this one continue to drop. And it could just be something like this, right? Where it drops and then goes back up and then slowly drops again. That's what I'm hoping for. I really hope that they stay the course long enough. If you look at sort of expectations at the Federal Reserve, or if you look at the CME group and expectations for what the Federal Reserve is going to do, they're not pricing in a rate cut at the meeting next week, which is a good thing. I don't really think we need another rate cut right now. If anything, they're not pricing in a rate cut until June. Right now, I don't think the market needs a rate cut. I think that the pain in the market right now is what is ultimately needed to bring inflation down. The difficult aspect of inflation, when you look at it historically, and also when you look at recessions historically, which we could be going into one for sure, but not all recessions are the same, right? I mean, you had a recession in 1990, which we've talked about a lot, which was basically just a 20% drop, and then we continued on our way, right? It's not like you have to have a 50% drop or an 80% drop or anything like that, right? Not all recessions are the same. There are times where you get drops that are not recessions that are bigger drops than the ones that you get in recessions. So please remember that they're not all the same. But The point that I'd like to draw your attention to is when you look at the S&P 500 and you overlay inflation onto the chart, one of the things you'll notice is that you never actually solve the inflation problem without a recession. Every time there's a spike with inflation, it ultimately leads to these green shaded regions, which are indicative of recessions. It's hard to truly tame inflation without seeing a recession on the back of it, right? And you'd be hard pressed to find a spike on here by inflation that's ultimately not ended with a recession. And again, it's one of those necessary evils that inflation, in order to tame the animal spirits, you have to have pain. And ultimately, you could argue that to truly bring inflation down to the target, you need to have pain. And that's exactly the pain that we're seeing right now in markets. You're seeing the S&P 500 sell off. I'm going to keep saying probably going to keep going down through March Opex at the very least, and could extend into early to mid-April if the market truly does need to wait for some more data points before ultimately deciding. I think there will be a counter trend rally later this spring going into potentially the summer. But right now, I don't really foresee any major changes until at least for another couple of weeks is my base case. And at least a week. I mean, it's possible that things turn around after options expiration in March, which is a little over a week away. But I also want people to recognize that the market, it very well could just simply wait for the data points that it will receive in April. And the reason why I think that could come to pass is if you actually look closely at the inflation chart back over here in 1972, the big move higher by inflation from like 3.8% to 4.8%, that data point was the March data point, meaning we got that data point in April. So the next data point that we get for inflation would be the same one that we saw back over there where it went up a full percent. So I could see that happening where the market waits around for another data point to get confirmation that this is not a repeat of the 1970s, but instead is something different. So those are my views on that. And if we were to go over to core inflation year over year, good news there. It also dropped. This has been fairly stubborn, though. It hasn't really dropped a whole lot. But this past month, we saw it drop from 3.29 to 3.14%. This is the lowest that core inflation has been really since 2021. Now, it hasn't really been moving a whole lot. I mean, it's been fairly stubborn. But anything that takes core inflation down, I think, is a good thing. Now, if they do achieve a soft landing where they just bring inflation back into that 2% target, then it would affect the bottom line of companies that can no longer pass off, higher and higher costs to consumers. So again, that's where you could be coming into that pain right now that we're seeing, and maybe that's the market ultimately pricing that in. But those are my general thoughts right now as it relates to the stock market, as it relates to inflation. And of course, I mean, Bitcoin is a risk asset, just like the stock market. And if the stock market goes lower, then the expectation would be that Bitcoin would ultimately go lower. Even in 2017, Bitcoin had a drop in early 2017 where it tested the 2016 high. So, and it happened, by the way, fairly early on. I would argue that's very much an outcome to consider for this cycle, testing the 2024 high, which is, in the lower 70s. As long as Bitcoin stays above that level, and I'm not saying it can't wick below it, right? No one's getting out of a bed for a wick. But if we get closes, and especially even if there's a wick into the low 60s, then there's a good chance the cycle's over. If it stays above the 2024 high, then the party could easily go on. The window of weakness for Bitcoin continues through March. And if you look at year-to-date ROI on Bitcoin, you'll see exactly what I'm talking about, right? Is that if you look at 2025 compared to 2017, the market was for Bitcoin was also weak in 2017. And it didn't truly start to pick up until April. The main difference between this cycle and 2017 is that in February of 2017, the markets went up. Whereas this February, the markets didn't go up in February, right? The markets generally have been dropping. Altcoins have been dropping. Bitcoin has been dropping. ETH has been dropping. We know ETH's been dropping. Most everything has been dropping basically since January 20th. The stock market made a slightly higher high in February. Most everything has been dropping. And you could argue that there was never really going to be a lot of true strength in risk assets this year until Q1 is over. The main question to figure out is the damage that is being done now in Q1, is it enough to begin the layoff cycle? Or is the economy strong enough to not get into the layoff cycle? If you're not familiar with what I mean by the layoff cycle, what I mean is that stocks going down leads to businesses laying people off. But as businesses lay people off, that weakens the consumer. Now, there's fewer people to go out and buy those products that those businesses make, which ultimately leads to more layoffs. It's a brutal cycle that you don't want to get into. Depending on how much damage is done now will dictate what happens later this year. If Bitcoin can get out of the current mess right now without going below the 2024 high, then the structure of the market is still intact. If it goes much below the 2024 high and goes into the low 60s, that's where the structure of the market is called into question a lot, right? And that's ultimately what I think, everyone's trying to figure out is, does Bitcoin test that, or does it hold support here? If it holds support at 70s, above 70K, 73K, structure of the market is fine. If it goes into the 60s, then I would argue that the more likely outcome would be a macro lower high in Q2, Q3, potentially around like the August timeframe. It could look something like this, right? If it goes down here, then you might get a bounce, but ultimately it would be a lower high. If it holds support here throughout this window of weakness, then the structure of the market is intact. You could argue that this gap right here between say 70K and 60K, you don't want it to go down there because, again, just looking at it from a charting perspective and looking at prior cycles, that could be the weakness that leads to layoffs, which would resolve ultimately in a lower high. You don't go down there, then maybe things aren't so bad and you don't actually get into that brutal layoff cycle that everyone ultimately wants to avoid. Those are my general thoughts on the market. I do appreciate you guys tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.